With 8 trading statements, 7 sets of first quarter results, a set of finals and 6 annual general meetings, we've got a packed programme of corporate events coming up, and that's before we get tucked into the macroeconomic news. For my money though, the most likely causes of a real fuss in the week ahead will be coffee and banks, because on Wednesday the 27th of April we've got full year results from Whitbread, and then Standard Chartered, Barclays, Lloyds and the Royal Bank of Scotland all produce first quarter trading updates on the 26th, 27th, 28th and 29th respectively. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to look at the key events which could shape market sentiment in the days, weeks and maybe even years to come. Let's start then with Whitbread, hotels to restaurants and coffee shops chain as it is, and that reports full year figures on the 27th of April. Boss Alison Brittain gave a trading update in March which revealed group like-for-like sales growth of 3.2% in the first 50 weeks of the year and total stated sales growth of 10.4%. Now for the full year, the analyst consensus expects 11% sales growth to just under 3 billion quid, a 15% jump in pre-tax profits to 533 million, and a near 11% hike in the divvy to just under 91p, and that would confirm Whitbread's presence in the elite list of 26 FTSE 100 firms who've increased their shareholder distribution for each of the last 10 years. Now other numbers to note include like-for-like sales at Premier Inn and restaurants, which includes his Beefeater, and also Costa Coffee, as well as any guidance for 2016 on issues such as site expansion and indeed sales and earnings. Analysts' hopes for a spin-off of Costa Coffee appear to have been dampened by the departure earlier this month of the operation's boss Christopher Rogers, and that may be one reason why the shares have been weak performers of late. At around 38 quid, the stock's trading a long way below its £54 high and a lot nearer its 12-month low, although concerns over consumer spending, the effects of terror attacks in Europe on the London tourism trade, and what had become a chunk of valuation may all have had a part to play too. At around 15 times for 2016 forecast earnings, a lot of the valuation premium has now at least been eroded. Now Whitbread's share price momentum may have cooled a bit, but its shares still aren't in the investors' doghouse anything like the same degree as the banks, the worst performing sector in the FTSE All Shares so far this year. This is a huge week for the sector, with Q1 trading statements due from four of the big five, and HSBC coming up the week after on the 3rd of May. And I think there are two themes to watch here. First, the incredible shrinking banks. In 2015, all of the big five reduced their risk-weighted assets and balance sheets under pressure from regulators to de-risk, become less complex and improve profitability. Investors frankly seem to want the same. The chart here shows the year-on-year declines for 2015, so let's see how Q1 compares. Second, oil exposure. Soothing words in January from the big US banks that their Q4 provisions would cover all eventualities were wrong. JP Morgan, Wells Fargo, Bank of America all took extra provisions to cover possible energy loan losses with their first quarter results early this month. So all eyes are now on the UK's leading lenders. Now Lloyds and RBS, they made no specific disclosures on their oil exposure in their full year statements or presentations. It's to be hoped this is a good sign. Standard Chartered disclosed its energy loan exposure was £9.6 billion, around 3% of risk-weighted assets. It didn't disclose an energy loan loss provision for Q4 or full year 2015. And Barclays revealed oil and gas loan exposure of £18.2 billion, 5% of group risk-weighted assets, and 106 million of impairments for last year. Barclays will also be of further interest for any strategic news from new boss Jez Staley, especially regarding its investment bank, where rocky stock and bond markets, slow trading volumes, quiet new issue markets and failing merger and acquisition deals have made the opening 3 months of the year a particularly tough one for the globe's investment banks, as duff results from America's Morgan Stanley proved. So thank you for watching, and I look forward to seeing you next time.